What if I told you that one of the most powerful forces in today's financial system has quietly ballooned into a $20 trillion machine? And it could end up shaking the very foundation of your retirement, your bank account, and even your job. Sounds dramatic, right? But stick with me, because what I'm about to explain isn't just Wall Street gossip. It's private equity. And whether you know it or not, it touches your life more than you think. Now here's the real kicker. What was once a niche corner of finance has grown so massive, so debt-fueled, that it's now threatening itself. The biggest danger to private equity today is private equity. So let's break this down step by step. The rise of private equity. 2 decades ago, if you asked the average person on the street about private equity, you'd probably get a blank stare. It was an insider's game. Small, boring, and almost a backup plan for people who couldn't land hedge fund jobs. Hedge funds were where the prestige and the big money lived. But things changed. A combination of regulatory shifts, investors looking for higher returns, and oceans of available cash turned private equity into a monster. Since the early 2000s, the industry has grown more than 20-fold. That explosion minted dozens of billionaires, swallowed up millions of businesses, and built a reputation that's, let's just say, not exactly glowing. Originally, private equity's edge came from being small and scrappy. They could quietly buy companies, improve them, and cash in without attracting much attention. But now, the machine has gotten too big, and the system it built is creaking under its own weight. You might be thinking, okay, but why should I care? Isn't this just a rich person problem? Not quite. The private equity model runs on one core principle: borrow as much as possible, then borrow some more. And when trillions of dollars in loans are tied to the assumption that growth will continue forever, well, you don't need me to tell you that assumptions like that don't always age well. If things unravel, the impact doesn't just stay on Wall Street. It hits Main Street banks, pension funds, and yes, everyday people like you and me. Let's pause for a quick refresher. At its core, private equity just means buying businesses or assets that aren't traded on the public stock market. Technically, if you buy into your cousin's coffee shop, congratulations. You're a private equity investor. But in practice, the big players are massive funds. They raise money from wealthy investors and institutions, throw in a bit of their own, then stack on as much borrowed money as possible to buy entire businesses. Here's how the cycle works. They buy a company. That company takes on huge loans. The private equity firm pulls out money through special dividends. The firm still owns billions in assets, even though they barely put in their own cash. And here's the kicker. The private equity firm itself isn't responsible for those loans. The businesses they buy carry the debt. Walmart borrows too much and collapses. You're not paying off the loan. You just lose the value of your shares. Private equity takes that same concept, but cranks it up to an extreme dot. It doesn't stop there. Once firms have a portfolio of companies, they can use it as collateral to take out even more loans, something called net asset value loans. People in finance often call it leverage on leverage. Even the money-wealthy investors contribute to private equity funds, often borrowed. Why? Because debt is tax efficient and lets them magnify returns. And when investors want to cash out early, secondary funds step in to buy their stake. But here's the catch. Even those secondary funds, which supposedly shouldn't borrow, often finance their purchases with debt too. So let's connect the dots. Debt funds the initial investment, props up the secondary market. Debt even finances the lenders that lend to private equity. It's leverage piled on top of leverage, stacked like a financial Jenga tower. This appetite for debt has given birth to a whole new industry, private credit. Instead of buying companies outright, some firms now specialize in just lending to other private equity players. Over the past decade, private credit has exploded to more than $1.6 trillion in the US alone. And because these aren't banks, and because private companies don't report like public ones do, it's nearly impossible to know the true scale of the risk. But one thing we do know, even these private credit firms borrow to fund their lending. See the pattern? Debt, debt, and more debt. So, where's the money coming from? Ultimately, it's not just wealthy elites fueling this. Pension funds, insurance companies, endowments, and retirement accounts in the places where your money quietly sits and grows are major backers of private equity. So when things go sideways, it's not just billionaires who get burned. It's teachers, firefighters, college grads saving for retirement, Here's the uncomfortable truth. Over time, very few managers can beat the overall stock market. Warren Buffett, Jim Simons, they're outliers, once-in-a-generation exceptions. Most of the time, outperformance comes down to luck, and luck runs out. Statistically, funds that crush it one year usually lag behind in the years that follow. Add in the hefty fees private equity charges, often 5 to 10 times higher than other active funds, and it gets even tougher to stay ahead. So why do investors keep shoveling money into private equity? Because in its early days, it actually worked. In the beginning, private equity didn't try to outsmart Wall Street. Instead, it bought local businesses, companies with real cash flows, run by hardworking owners who maybe weren't experts in accounting, marketing, or scaling. Private equity teams could step in, streamline operations, add value, and grow these companies. It wasn't glamorous, but it worked. Buying a plumbing company in Ohio and setting up better bookkeeping software may not sound exciting, but it was profitable. But over time, as more firms entered the game, the easy opportunities dried up. Prices rose. Today, even small HVAC businesses can sell for 5 to 10 times their annual earnings. At those prices, after fees and expenses, beating the market is almost impossible. So firms got creative. They started selling businesses to each other. One firm buys at a higher price. The seller books a nice return, and the cycle continues. Returns looked amazing, on paper. But that feedback loop only works in one direction. When interest rates are low, credit is cheap, and investors are hungry, everything looks great. But when the music stops, when cash dries up, when skepticism grows, when deals slow down, the whole cycle starts to wobble. And right now, that wobbling is getting louder. Fundraising for private equity has dropped by more than a third this year. 2025 is shaping up to be the weakest year in over a decade. Big institutional players, even Ivy League endowments like Harvard, are selling stakes in private equity funds at discounts just to raise cash. When new investors can buy existing stakes cheaper in the secondary market, why would they put fresh money into new funds? That's a big problem for private equity firms that rely on constant inflows of capital to keep flipping deals. And remember, underneath it all, there's that web of debt that still needs servicing. If the deal-making slows and the loans come due, things could unravel fast. There's one bright spot: distressed debt funds. These are firms that specialize in lending to companies on the brink of collapse. They've raised record sums recently, over $21 billion. That's great news if you're running one of those funds. But let's be honest, the fact that distressed investing is booming is not exactly a glowing sign for the health of the system. If private equity's debt tower collapses, the fallout won't be limited to billionaire investors. The loans tied up in this system are often packaged into bonds and sold to pension funds, retirement accounts, and banks. In other words, they land right in your backyard. Now, to be clear, this isn't a carbon copy of 2008. The risks aren't as concentrated or as toxic as the subprime mortgage crisis. But if private equity stumbles badly, the ripple effects will hit small businesses, local jobs, and everyday savers. Private equity was never supposed to become this massive. It started as a clever way to help businesses grow and give investors a shot at higher returns. But debt stacked on debt has transformed it into a fragile ecosystem where the greatest risk isn't a competitor, or even the market, it's itself. And that's why, whether you realize it or not, you should be paying attention. If you found this breakdown eye-opening, hit that like button, subscribe, and share this with a friend who thinks finance is boring. Because when trillions of dollars are on the line, boring can suddenly get very exciting. And if you want to dive deeper into the darker side of private equity, the impact on workers, communities, and everyday businesses, check out my next video. Trust me, you'll want to see it.